Professor of Commerce. Let us begin with the session for the Become Third Semester course, subject entitled Indian Financial System. This is with first unit entitled An Overview. Under that, the meaning of the Indian financial system, which reveals the entire concept of the Indian financial system. The financial system plays a significant role in the economic development of a country, especially in case of developing countries like India. The financial system of mobilization of funds for economic development, growth and development for the country. The financial system facilitates the mobilization of funds for the economic growth and development of the country and its residents. The Indian financial system establishes the bridge between people having surplus funds and people with deficit funds, so that funds available could be better utilized for the individuals or business or corporations who know how to multiply it. In this unit, let us understand the whole meaning of Indian financial system, key components of Indian financial system and its definition, functions and features. The economic development of any country depends upon the well-organized financial system. Financial system is a system which supplies the necessary financial inputs for the production of goods and services to improve the standard of life and well-being of the nation. It includes financial markets and institutions. It deals with money and monetary assets. What is financial system? The economic system of the country consists of two segments: people with surplus funds and people with deficit funds. The individuals with deficit money will have orange money, and people with surplus money willing to invest so that can yield returns on it. Therefore, the financial system provides link between lenders and borrowers, so that money definition of financial system. The financial system is defined as composition of different financial institutions, market regulators, transactions, analytic agencies, and fund managers. Thus, the financial system develops a common platform for borrowers as well as investors, so that investors may invest their money and borrowers may arrange funds. Financial system is a set of complex and closely connected with the financial institutions, financial markets, financial instruments and financial services, etc. Process by which money flows from savers to users. Transfer of money between investors and borrowers helps in formation of capital, meets the short-term and long-term capital needs of households, corporate houses, government and foreigners. Its responsibility is to mobilize the savings in the form of money and invest them in the productive manner. Now let us consider the financial system of India. We can categorize the Indian financial system into two sections. Information section. Money lenders, local bankers, traders and lenders basically come under the formal section. Now let us explore the formal section of the Indian financial system that consists of the following 5 components, which are also known as elements of the financial system. Number 1 is financial institutions. It includes banking institutions, non-banking institutions. Number 2 is financial markets. It includes money market, capital market, forex markets, commodity market. Number 3 is financial instruments. Money market, capital market, derivative instruments. Number 4 is financial services. General banking services, insurance services, investment services, foreign exchange services. Number 5 is financial regulators. Based on the market levels, primary markets are there, secondary markets are there. A primary market is a market for new issues or new financial claims. Therefore, it is also called a new issue market. The primary market deals with those securities which are issued to the public for the first time. Secondary market, a market for secondary sale of securities. In other words, securities which have already passed through the new issue market or traded in this market. Generally, such securities are quoted in the stock exchange and it provides a continuous regular market for buying and selling securities. Simply, food primary market is the market where the newly started companies issue shares to the public for the first time through initial public offering. Secondary market is the market where the second-hand securities are sold. Based on the security types, money market and capital markets are there. Money markets is a market for dealing with the financial assets and securities which have a maturity period of 2 to 1 year. In other words, it's market for purely short-term funds. Capital market. A capital market is a market for financial assets that have a long or indefinite maturity. Generally, it deals with the long-term securities that have maturity period of above 1 year. The capital market may be further divided to 3 types: industrial security market, government securities market, long-term loans market. Equity markets. A market where the ownership of the securities are issued and subscribed is known as equity market. Debt market. The market where funds are borrowed and lent is known as debt market. Arrangements are made in such a way that borrowers agree to pay the lender the original amount of the loan plus some specified amount of interest. Derivative markets. A market where financial instruments are derived and traded based on the underlying assets such as commodities or stocks. Financial service market. A market that comprises participants such as commercial banks that provides various financial services like ATM, credit cards, credit rating, stock broking, etc. is known as financial service market. Individuals and firms use financial services markets to purchase services that enhance the working of debt and equity markets. Depository markets. A depository market consists of depository institutions such as banks that accept deposits from individuals and firms and use these funds to participate in the debt market by giving loans or purchase other debt instruments such as treasury bills. Non-depository market. Non-depository market carry out various functions in financial markets ranging from financial intermediaries to selling, insurance, etc. The various constituencies in non-depository markets are mutual funds, insurance companies, pension funds, brokerage firms, etc. Relation between bonds and commodities. With the increase in commodity prices, the cost of goods for companies increase. This increase the commodity price levels causes or rise in inflation. Relation between commodities and equities. Due to the production cost remaining same and revenues rising, the operating profit increase, which in turn drives up equity prices. Financial system consists of a varieties of institutions, markets, instruments rated in a systematic manner and provide the principal means by which savings are transformed into investments. The system that allows the transfer of money between savers and borrowers. Financial institutions. The first component of the financial system is financial institutions. The financial institutions are private or government entities which offer several services to the general public and business for the management funds. The financial institutions work as an intermediary between depositors or investors and borrowers. Thus, financial institutions fulfill the gap between lenders and borrowers. For instance, commercial banks, cooperative banks, insurance companies, stock brokers, mutual funds, companies are some examples of financial institutions. The financial institution can be 2 types. Banking and non-banking. Financial markets. The financial market is the marketplace where the actual transactions of financial instruments takes place between 2 persons or parties. The financial markets can be broadly divided into 3 categories: money market and capital market. Forex markets. It deals with money market. It is the marketplace where the short-term securities like treasury bills, repo, commercial papers, etc. are issued and traded over the counter among people. capital market. It is the marketplace where the long-term securities like stock, bonds, debentures are issued and traded. Bombay Stock Exchange Market, National Stock Exchange Market, New York Stock Exchange Market are some of the examples of the capital market. It can be further divided into three categories: primary market, secondary market, and derivative market. Forex market. It deals with exchange of foreign currencies and determines the rate of exchange of currencies as well. Commodity market. It basically deals with commodities like gold, silver, crude oils, etc. Financial instruments. A financial instrument refers to a monetary document, contract between two parties which are traded in financial markets. It represents an asset of one party and the same time liability of the other party. Classified as money market instruments. Money market. Money market instrument is the short-term debt financing instrument to enhance the liquidity of business, typically traded over the counter. Deposit. It is the dematerialized certificate of deposit. It is the dematerialized form of funds lent to the corporations for stipulated time period against interest. The operating procedures are the same as fixed deposit provided by the special negotiation. Commercial papers. It is unsecured short-term debt instrument usually having a maturity period 7 days to 1 year. Typically issued by the large cap companies for the purpose of fundraising. Treasury bills. It is a short-term debt instruments issued by the central government of India only having a maturity period up to 1 year. Repurchase agreement, repo. The commercial banks and other financial institutions borrow the funds for the Reserve Bank of India for a short term through repurchase agreement by selling government approved securities with a promise to purchase in future dates. Call money. Whenever a loan is granted for 1 day and has to repay the next day, it is called call money. Commercial papers. The commercial bills are also traded in the market and are utilized to raise the funds against the receivables. Such practices of raising funds at discount is called a commercial bill or invoice discounting. Bankers' acceptance. It is another money market instrument which are widely used in the financial market. Bankers' acceptance refers to the extension of loan to the stipulated banks against a signed guarantee of repayment in future. The system to allocate savings efficiently in an economy to ultimate users either for investment in real assets or for consumption. It is a complex integrated set of subsystems. These systems are financial institutions, markets and instruments. Capital instruments. Capital instruments refers to the long-term capital financing instruments traded on the recognized stock exchange. The corporation issues to such financial instruments to raise long-term funds from general public. Equity shares, preference shares, debentures, corporate bonds. Derivative instruments. The derivatives are those financial instruments which don't have their own value. Instead, its value derived from underlying assets. It utilizes to hedge the risk associated with price fluctuation of the securities, forward, future, option, swaps. Exchange and traders utilize to hedge the risk associated with price fluctuation of the securities like forward, futures, options, swaps, exchange traded funds. Financial services. The services offered by the financial institutions for the management, lending, borrowing and investment of funds are called financial services. There are basically 4 categories of financial services offered in India. General banking services. The services offered by the commercial banks or other banking institutions such as deposits of money, guaranteeing loans and advances, bill discounting, credit, debit cards, credit or debit cards, accounting opening. Insurance services. The various insurance policies like life insurance, health insurance, car insurance, etc. are sold under these kinds of services. Investment services. These various financial institutions such as stockbrokers, merchant and investment bankers, primary dealers provide investment and asset management services to the business and corporations like loan syndication, underwriting of services, trading of stock and other securities, mergers and acquisitions, fundraising services, depository services, honor sharing trading, credit rating services, foreign exchange services. These are the special services which deal in exchange of foreign currencies. Financial regulators. Financial regulators refers to the government bodies which are responsible for regulating, inspecting, monitoring the functions of various financial institutions like banks, insurance companies, business entities, non-banking financial companies, etc. Financial regulators are the apex bodies of financial institutions of respective sectors which register and functions under the financial regulatory institutions. Few examples of the financial regulators in India are RBI stands for Reserve Bank of India, IRDA stands for Insurance Regulatory and Development Authority, SEBI stands for Securities Exchange Board of India, PFRDA stands for Pension Fund Regulatory and Development Authority, FMC stands for Forward Market Commission. Functions of financial system. In the eyes of the economic development of the country, the financial system encourages money into the circulation and allocates it to individual, business and corporation. The financial system of a country is not a solo body, but it consists of other institutions as well as corporation, and in this way the whole system.